Google be a player in China?
I'm happy to take some of that. First of all, there's a sort of idea that China is not consuming enough, and that's right to a certain degree, because China's household savings ratio is very high, about 35% or so, which compares with single digits for the majority of the Western world. But that ignores one key factor, which is that if your savings rate is constant at 35%, but your economy is growing at 10% a year, then consumption itself is still growing at about 10% a year. It's just that it's not a particularly high share of GDP. If you look at the contribution that Chinese consumers are making to global consumption growth, last year it was about the same as the US, because the growth rate of China's consumers was so much higher than is the case in the US itself. For the years ahead, one of the big questions is what happens with China's current account surplus, which effectively is a story about whether China will shift more towards a consumer-led story rather than an investment-led story. I think the answer is eventually China's current account surplus would come down, but not as a consequence of exchange rate revaluations. And the reason for saying that is that one fantastic example of continuous exchange rate revaluations over the last 30 or 40 years is Japan. The yen has gone from about 360 at the beginning of the 1970s to 80, 85 today. And yet despite what has been an extraordinary rise in the value of the yen, Japan's current account surplus as a share of its GDP has continuously gone up. There hasn't been a relationship with the kind of people expect between the currency and the current account position. What has to change in China? Twofold. First of all, the development of a decent, proper, functioning consumer credit system, which China is still a long way away from creating. And the second thing that has to change is a shift towards a properly functioning social security system, which is mediocre at best at the moment. And the problem is that if you have a poorly functioning social security system, individuals feel obliged to save a lot more out of their income than would otherwise be the case. So unless those things come through, I think the Chinese consumer will still tend to be seen to be disappointing in the West.
Good, thank you. We have a couple of questions that came up that sort of are interrelated, so I'll put them in some kind of order that I think you could all pick on it. But I thought this one was interesting. Does Bernanke understand macroeconomics? I don't know who came up with that one. That was a good one. Can everybody hear me? Okay, maybe this mic is better. All right, so we have a couple of questions that are sort of interrelated. The first one was, does Dr. Bernanke understand macroeconomics? Maybe he needs a refresher course, I don't know. But anyway, also, given the last two economic cycles, do you think the Fed should be following credit spreads rather than employment and inflation to determine monetary policy? And the second one, do you expect to see inflation in the horizon? If so, where from besides commodities and headline inflation? And the last one, how does one invest in bonds in a steadily rising interest rate environment? Stay short term, buy short funds, run for the hills if you have bonds? I don't know. But anyway, why don't we get a little bit of perspective since all of them are sort of Fed kind of related.
I'll just talk quickly about all of them. Just to comment, I just want, because I don't know how many technicians are here. Let me just explain something if I could. Look, I say this to my team all the time. A chimpanzee can draw a line on a chart. So we don't get into our trend lines are better than your trend. This technical strategy has nothing to do with that. Really, technical strategy is market psychology. It's behavioral finance. It's watching money flows. It's watching how psychology and patterns form based on history. It's like being a historian. So really, trend lines, I can appreciate what you're saying. Just like you can revise a forecast, you can break a trend line, but that really is not what technical strategy is. It's following psychology and money flow globally throughout the asset classes. So that, just want to clarify it in terms of what we do. Now, in terms of does the Fed, in terms of opinion of the Fed, I'll just say this. The bond market leads the Fed, not the other way around. It always has, it always will. And I can show that to you. We just lay out 2-year yields, lay out the yield curve on top of the Fed moves. If we go back to the last time the Fed started to raise interest rates, the bond market started to move yields higher, especially in the front end, 12 months beforehand. Then them, and the Fed came in and started to jack up interest rates. I'm not sure if it was 16 or 17 times in succession, and they forecast that very, very clearly. Instead of selling off, the bond market was big because it had sold off a year beforehand. Same thing with the yield curve. The curve had flattened out over 80 basis points in 2/10 look at the U.S. yield curve the last time the Fed started to move. So I'm, put myself on a limit at CFA Society, but what should the Fed be watching? They should be watching the bond market. We know going back before the credit crisis, if you want to know what the Fed was going to do, we just watch Fed funds future. I should say I'm an ex-government bond trader from Toronto, Canada, CIBC Wood Gundy. So I come from this managing a P&L and done pretty well in this. So I think, number one, the market leads the Fed, not the other way around. And I could go into that with Europe, but I'll just leave it for that. As for commodities and whether there's going to be inflation, look, it doesn't matter if there's inflation. Let me say that. What matters is whether the market perceives there's inflation, and whether there was market perception of inflation, because that's what we invest in. We invest in the market. That we have a market that's an inflation market. We have the TIPS market. And of course, we're biased. Barclays obviously is a major TIPS house, but look at the break-evens in the U.S., 2010s. Look at break-evens in the U.K. Look at break-evens in Germany, especially in the U.S. If you look at 2010s, we are right at the levels we were before the credit crisis began. We only have to go another 30 to 40 basis points before we trigger a lot more people to buy break-even. So number one, from the deflationary scare, the market is pricing in inflation, and it is on the verge of a breakout, especially in the United States. Number two, to consider commodities, don't dismiss them. Softs, ags, look at the precious metals markets. Have you seen what the whites have been doing? The whites tend to lead in an inflationary environment, and that means platinum, that means palladium, and of course, you may know palladium has been red hot silver, outperforming the gold market. So what else can we see in the inflation markets? I'm extremely bullish gold, and I have been for 6 or 7 years, but palladium is on fire. Silver, they look at the gold-silver ratio, is still going to the downside. Still silver is outperforming, and I'm going to guess there's no fundamental reason to explain that, but the gold market always does, and the whites always do warn us of something ahead of time. So it's an interesting academic question, and I do promise you in 3 or 4 years we will look back and say, boy, what was the gold market warning us about? Because in the 70s it warned us about inflation. It's warning us about something to us right now in the commodity markets. And the final thing I'll suggest is you look at the emerging market equity indices. Now in EM space, you have to be selective. This is not a blanket buy EM. You have to be selective. For example, the Shanghai Composite's gone nowhere for 18 months, but if you look at something like the Kospi, it's done extremely well. Even in Latin America, everybody says buy the Bovespa, but you know what? The IPSA, Chile, much better. My favorite is the Merval, much better market, so you have to be selective. But if the emerging market equities are continuing to the top side, which ultimately we think they will, then you're just going to have further demand, and we ultimately think the dollar is going to continue to weaken. The trend is still in place despite the chop that probably lasts through the year. So if you have demand in EM space and you have a weaker dollar, there's a lot of venues where you can see why the market is pricing in inflation.
Did you want to add to it?
Yeah, I'm very happy to talk about the question on Dr. Bernanke, whether he understands macroeconomics. Yes, in part. I think we may answer, well, of course he understands macroeconomics. The issue, though, I think, is whether the Federal Reserve has promised too much. In fact, central banks in general have promised too much. They cut interest rates, they launched all these unconventional policies. The idea was to prevent a Great Depression Mark II, and that's been prevented, so that's great news. But they made a further promise, which is to say they can get us back to normal, when normal is defined by what was happening prior to the crisis. Prior to the crisis wasn't normal. Prior to the crisis was a housing boom. It was massive increases in securitization. It was dodgy lending, dodgy credits. All these things were going on, so why on earth would you want to return to that particular position? So I think the problem is that the central banks are promising too much. Not just that they can stop a Great Depression, but somehow they can fix all the problems that we've seen over the last 2 or 3 years. And that's where I think the difficulties come through. And that's where I think that people will be disappointed about what Bernanke and others will achieve over the next few years.
I would just like to take the investment in bonds. I think, I'm not sure if people are necessarily commenting on U.S. Treasuries or bonds generally speaking. I mean, I invest in emerging market debt. I invest in emerging market bonds. Again, since my history of involvement in this asset class, this is an asset class that has delivered double-digit returns for the last, average annualized returns in excess of 10%. So had you been invested in bonds, you would have done well. And as I look at, the reason for that, very simple. There's a simple carry component to bonds, and then there's also the potential for spread compression, which can offset a rise in interest rates. And, that's what we've seen in some of our emerging corporate debt, is that even while U.S. interest rates have been increasing, which is after all what these bonds are tied to, the spread the spread demanded by investors for these bonds has gone down and has actually offset the increase in interest rates, and as a result, the pricing of these bonds has gone up. So not only have you earned the carry, but you've also had some capital appreciation.
Could I just make a comment on Jordan's comment about inflation? I was listening very carefully to what you're saying, I think, because you're speaking extremely quickly, but I think I caught up with most of it. But I think what does matter for markets is the type of inflation, what's going on. And if you go back to the 1970s, the inflation that was in existence back then was mostly what you might describe as a wage-price spiral. Prices went up, wages went up, wages went up, prices went up. It was a pretty unstable situation. The inflation that we're seeing in parts of the Western world today, and I'm thinking here of my country, the UK, where actually inflation's picked up pretty swiftly, is not a story about price inflation and wage inflation. It's just about price inflation. Prices have risen significantly, but wages haven't. So in real terms, people are actually worse off. So the big question there is it the inflation itself that's the problem, or is it instead the squeeze in real wages as a consequence of the inflation, which is the problem, because that may choke off the recovery? So this kind of inflation is different from the 70s. It matters because it may choke off the recovery.
Can I just jump in on the bond market? Look, I swear to God, I thought I was talking slowly. I'm sorry. I do.
Turn this light down.
Okay, all right. Look, the bond market, let's talk about what's happening right now, because you're here to get investment ideas or things to watch for, so let's be really specific on some things. Look, the last 7 to 10 days in the Treasury market, what has changed? What has changed is that, of course, Treasuries have broken up from what was a multi-week range and killing all of us, but two-year yields started to scream to the top side, and I think that's really, really important. First of all, go back, I think it was about a year and a half, 2 years ago. Do you remember you had a couple of payrolls that came in better than expected? And those of you who watch Treasuries or trade the bonds, do you remember two-year yields had an intraday range of 40 basis points on one day, 50 basis points on the other day? I don't care. Technicals, fundamental, quant, nobody's catching that. But that's how sensitive the front end of the yield curve is to positive news, positive data. Now, I'm biased. I think the market leads the economy, not the other way around, but that's fine. But if we're still bullish on the stock market, if the market's been going higher, we would expect the economy to continue to improve and the data to continue to improve. So what we're starting to see is two-year yields are starting to break out. Now, the curve is still steepening. 2-10's up at 300 basis points, so the front end is outperforming. But if the stock market holds the bid, the economy continues to improve, then by the end of the year, we are going to be back in the environment where we are going to see these knee jerks and two-year yields in the front